A good way to think about it is if you're married and you're worth about 25, 26 million, you're pretty much good right now. If you were to die before these exemptions are set to expire.
How do we use the Deferred Sales Trust to reduce estate tax or prepare a client who they might be in an exit plan now? While there's a very high number of $22 million, but we don't know the future. So what can we do to prepare them for the worst case scenario?
Absolutely. And so the key points here is in the United States, the term death tax or estate tax refers to estate and inheritance taxes. The estate tax is a federal tax on the transfer of the estate of a deceased person. This tax is applied to a property or assets transferred through a will, or in cases where the deceased did not leave a will, the property is transferred based on state laws, individual state laws. And so some key points here to consider is, death tax is just another way to describe estate or inheritance tax. That's key. And then all assets that are inside of the taxable estate that are valued essentially $12 million per person right now as of 2023. There's a little bit of inflation that's kind of built in for that. But a good way to think about it is if you're married and you're worth about 25, 26 million, you're pretty much good right now. If you were to die before these exemptions are set to expire in 2026, essentially, where it's going to cut in half or maybe even lower.